Understanding assets and liabilities is fundamental to personal and business finance. They form the backbone of your financial statements and are critical in assessing your financial health. Here's an in-depth exploration of these concepts, complete with examples and practical information. Assets. Assets are resources owned by an individual or a business that have economic value and can provide future benefits. They are what you own that can be converted into cash or used to generate income. Assets are typically divided into several categories. Yes, 1. Current assets. These are assets that are expected to be converted into cash or used up within 1 year. They are crucial for day-to-day operations and liquidity management. Examples include cash and cash equivalents. This includes currency, bank accounts, and other liquid investments like treasury bills. For instance, a company's cash reserves or an individual's savings account balance. Accounts receivable, money owed to a business by its customers for goods or services delivered. For example, if a company sells products on credit, the amount due from customers is accounts receivable. Inventory, goods available for sale, raw materials, and work-in-progress products. A retail store's stock of clothing or a manufacturer's supply of raw materials are inventory examples. Prepaid expenses, payments made for services or goods to be received in the future, such as insurance premiums or rent. 2. Non-current assets. These assets are long-term investments not expected to be converted into cash within a year. They are essential for strategic operations and growth. Examples include property, plant and equipment, PP&E, tangible assets like buildings, machinery, and vehicles used in operations. For instance, a factory owned by a manufacturing company. Intangible assets, non-physical assets with value, such as patents, trademarks, and goodwill. A tech company's patent on a unique software algorithm is an intangible asset. Long-term investments, investments in stocks, bonds, or real estate intended to be held for more than a year. For example, a company's stake in another business. Deferred tax assets, taxes paid or carried forward that can be used to reduce future tax liabilities. 3. Examples of personal assets, real estate, a person's home or investment properties. Vehicles, cars, or other vehicles owned outright. Investments, stocks, bonds, mutual funds, or retirement accounts. Collectibles, art, antiques, or rare coins. Liabilities. Liabilities are obligations that represent what an individual or a business owes to others. They are debts or financial responsibilities that must be settled over time through the transfer of money, goods, or services. Liabilities are also categorized into current and non-current. 1. Current liabilities. These are obligations expected to be settled within 1 year. They are important for assessing a company's short-term financial health. Examples include accounts payable, money owed by a business to its suppliers for goods or services received. For instance, a company's unpaid bills for office supplies. Short-term debt, loans or credit lines that must be repaid within a year, such as a business's bank overdraft or a personal credit card balance. Accrued liabilities. Expenses incurred but not yet paid, like wages payable or interest payable. Unearned revenue, money received before services are rendered or goods delivered, such as advance payments for a subscription service. 2. Non-current liabilities. These are long-term obligations not due within the next year. They are crucial for understanding a company's long-term financial commitments. Examples include long-term debt, loans or bonds payable over a period longer than 1 year, like a mortgage or corporate bonds. Deferred tax liabilities, taxes owed in the future due to temporary differences between accounting and tax treatment. Lease obligations, long-term lease agreements for property or equipment. Pension liabilities, obligations to pay future retirement benefits to employees. 3. Examples of personal liabilities, mortgages, loans taken to purchase real estate; student loans, debt incurred to finance education; car loans, loans taken to purchase vehicles; personal loans, unsecured loans for personal use. The relationship between assets and liabilities. The relationship between assets and liabilities is crucial for understanding financial health. This relationship is typically represented in the balance sheet, a financial statement that provides a snapshot of what you own and owe at a given point in time. Equity or net worth equity for businesses, or net worth for individuals, is the difference between total assets and total liabilities. It represents the residual interest in the assets after deducting liabilities. In simple terms, an in-text equity net worth, a in-text total assets, a text total liabilities, a positive equity or net worth indicates that assets exceed liabilities, suggesting financial stability. Conversely, negative equity implies that liabilities surpass assets, which may indicate financial distress. The importance of a balanced approach. Maintaining a balance between assets and liabilities is essential for financial health. Excessive liabilities compared to assets can lead to financial strain, while a strong asset base can provide security and growth opportunities. Here are some strategies to manage this balance. Debt management. Keep liabilities in check by avoiding unnecessary debt and prioritizing high-interest debt repayment. Asset growth. Focus on increasing assets through investments, savings, and acquiring appreciating assets like real estate. Regular financial reviews. Periodically review your financial statements to ensure a healthy balance between assets and liabilities. Practical applications. Understanding assets and liabilities is not just theoretical, it has practical applications in everyday financial decisions. For individuals, budgeting and saving, knowing your assets and liabilities helps in creating realistic budgets and savings plans. For example, understanding your liabilities can help you allocate funds towards debt repayment. Investment decisions. A clear view of your assets allows for informed investment choices, balancing risk and return based on your financial position. Retirement planning. Assessing assets and liabilities is crucial for retirement planning, ensuring you have sufficient resources to cover future liabilities. For businesses, financial planning. Businesses use asset and liability analysis for strategic planning, ensuring they have the resources to meet obligations and invest in growth. Creditworthiness. A company's balance sheet, showing assets and liabilities, is a key factor in assessing its creditworthiness for loans and investments. Risk management. Understanding liabilities helps businesses manage financial risk, ensuring they have adequate assets to cover potential losses. Conclusion: assets and liabilities are foundational concepts in finance that provide insight into an individual's or business's financial health. By understanding and managing these elements effectively, one can make informed financial decisions, achieve financial goals, and maintain stability. Whether through personal budgeting,